Hey everyone, David Coe here with the Co Real Estate Group. Hey, one of the questions we get asked all the time is about people that are looking to sell their property and they have a huge capital gain hit they're going to take on a highly appreciated asset. So today I brought in a good friend of mine, Isaac Kem with LPL Financial. As you can see from Isaac's background, he specializes in helping people to navigate the capital gain tax issue. So Isaac, thank you so much for spending some time with us here today.
Hey, David, thank you for allowing me to be here. I think we'll some interesting stuff that most people don't know about.
Awesome. Well, give us a little introduction. Kind of talk about what you do and your practice.
So, I am a financial advisor. I help people plan for their financial future. I help them invest their money. But there's a lot of financial advisors who do that. And so I want to have a specialty that people remember me and people come to me for that specialty. And so what I talk about is what you see over my shoulder, capital gains tax reduction or elimination strategies. If you sell something expensive and you have a lot of capital gains tax you have to pay, I may have some strategies that will help you deal with the capital gains tax. People typically call me when they sell their home, their residence, they sell a business, or they sell investment real estate. If you're selling one of those three things, I probably have a strategy that you should at least be aware of.
Cool. Well, look, we're mostly, I think, especially on the real estate side, we do have a lot of clients that are, selling highly appreciated assets. And for those of you that don't know, like if you are a single person, you get a $250,000 exemption if you sell a piece of property. If you're a married person, you get a $500,000 exemption. But there are plenty of properties in the South Bay that have way more tax on top of that typical base $500,000. So let's kind of jump into it. I know you've got three primary strategies that you use, and the first one is well, the first two are DSTs, but they're different kinds of DSTs. The first one's a deferred sales trust. Can you talk about how that works?
Yeah, so a deferred sales trust, we call it an intermediated installment sale. But with a deferred sales trust, let's say someone is selling a home and let's say it's a $3 million home. With a deferred sales trust, they can sell that property and they will defer paying the capital gains tax. So you don't pay it now, you pay it later. The benefit of paying it later is if you sell a home for $3 million, we can invest all $3 million because you're not paying the tax now. So because we invest $3 million, that can maximize the income that you can get from the sale of the property. So on a $3 million property and you sell it, it's your home. Let's say after taxes, you would net $2 million. Again, with the deferred sales trust, you can invest all $3 million. So if we can give you 6% income on the money, 6% on $2 million is $120,000 of income. 6% on $3 million is $180,000 of income. So if having that higher level of income interests you, then this is a strategy you should consider. It's not right for everybody, but if deferring the tax and keeping more money in your account and generating more income sounds like a good idea for you, this is just something you should investigate further.
So basically, they invest $3 million, which I'm sure you invest in a range of other financial products.
Correct.
Does the tax happen as you make income off the investment? Is that where the taxable event happens?
No. So going back to the $3 million, and let's assume you're getting 6% interest income. We will give you 6% income on that $3 million. So that $180,000, that's taxed as ordinary income, like bank interest. Okay. So if you get interest from the bank, you just pay ordinary income tax on it. On the $3 million, you don't pay any capital gains tax on that until you take the original principal out of the trust. We're going to set up a trust account. We'll put the $3 million in the trust account. If you don't take out the $3 million principal, you don't have to pay capital gains tax. So as long as that money stays in the trust account, you don't have to pay capital gains tax. If in year two or year three you say, hey, I want to take out $300,000, we'll give you the $300,000, but then you have to pay capital gains tax on that $300,000. And the promissory note would go from $3 million down to $2.7 million.
Got it. And it's the same tax rate that I'm paying on that, but technically I'm paying it 3 or 4 years down the line where the value of money is higher, so I'm not paying as much. And I would assume the ultimate gain is if I never take money out and I leave it to my heirs after I pass away, then they'll get a step up in basis and they can take that money and not pay capital gains tax. Is that how that works?
So no, unfortunately on this one, you do not get step-up basis.
Okay.
So if you sell that home for $3 million, eventually capital gains tax will have to be paid. The question now is, do you want to pay it today or would you
Right.
like to pay it 20 years from now?
I got it.
And what I tell people, because I don't give tax advice, I'm a financial advisor, but what I tell people is, as a general rule, if you don't have to give your money to the government, then keep it in your pocket, right?
Right.
I mean, well, why give it to them if you don't have to? And then, as you mentioned, a side benefit is when you do eventually pay the government and you pay them in the future, 20 years from now, the value of $1, it's going to be much lower than $1 today, right? Because of inflation. So when you do pay the IRS, when you do pay the Franchise Tax Board in 20 years, each dollar you give them is worth much less.
And I also assume that I could play the look politically capital gains tax rates flow based on whatever party's in power, right? So I could also use that as a strategy to maybe take money out when capital gains taxes are lower as a whole. Is that correct?
Yeah, yeah. I mean, if you, one of the good things about this is in conjunction with your tax advisor, or your CPA, we can talk about different ways that you can take money out of here. Now, we don't want you to decide, take money out in little chunks every month. The IRS might think that you control the money, and if they think you control it, then they will be unhappy and they won't like the strategy. So, but $100,000 here, $300,000 there, you can get your money out and we can work with it. Just you don't want to use it like an ATM, that's all.
Understood. Okay, that's a really good overview. Let's move on to the second DST, the
Okay.
Delaware Statutory Trust, which, the good thing about the DSTs is I know a lot of people that are actually 1031 exchange investors also like these DSTs. But if you are a single family homeowner, you can't 1031 exchange your primary residence,
Right.
but you can invest that into a DST. So first talk a little bit about what the Delaware Statutory Trust are and why it's different for a homeowner versus an investor.
Right. So with the Delaware Statutory Trust, you can only do it with rental property. So if you are selling your residence, the home you live in, you cannot use a Delaware Statutory Trust.
Hmm.
It really makes sense if you're doing a 1031 exchange, meaning you're selling some kind of a business property. It can be a 50-story office building. It can be a rental condo or a single family residence that you're renting out. If you rent it out and use it in a business, you can do a 1031 exchange with it when you sell it. So a Delaware statutory trust is an IRS approved way to complete a 1031 exchange. In a typical 1031 exchange, if you own a rental property and that's property number one, what you do is you sell that property and you buy a replacement property number two and you defer the payment of tax. With a Delaware statutory trust, you sell property one, but instead of buying a replacement property, you buy shares of a Delaware statutory trust, and that trust owns real estate. If you buy shares of the Delaware Statutory Trust, the IRS publicly announced we will accept that as a 1031 exchange. So it's just another way to complete a 1031, but the Delaware Statutory Trust is not for everyone. If you are in real estate and your goal is to maximize your income, maximize your financial return, the Delaware Statutory Trust is not the right solution in a 1031 exchange. You want to go out and you want to buy a rental property. But in a couple of situations, it's really, really valuable to know what a Delaware Statutory Trust is. And so the situation where I use this the most and where it has the most impact is with seniors. They own a rental property or they may own several rental properties. and they want to get out of the market. They don't want to manage real estate anymore. But David, as you know, if they sell that property, they're going to have to pay capital gains tax, and they don't want to do that. Also, if they hold the property until they pass, they get something called step up basis and they can give it to their heirs and the tax will be zero. So those people, elderly people, they're like, I'm just going to hold it until I die and my heirs will get it tax free. A Delaware statutory trust allows that senior to sell their property, right? You can go through David Co. David Co. can sell that rental property for you. And the proceeds, we can take it and put it into a Delaware statutory trust. They just did a 1031 exchange, so they don't have to pay any tax. But in a typical 1031 exchange, when you buy a replacement property, you still have to deal with tenants and you still have to manage a property. With a Delaware statutory trust, you buy a trust that owns real estate. That real estate is managed by a third party. So as a senior, if you sell your rental property, not only do you do a 1031 and you don't pay tax, but you don't have to manage any more real estate. So for that elderly person, that's a huge win-win. But that's not all. There are other benefits with the Delaware statutory trust. Another benefit of the Delaware Statutory Trust is, as I mentioned, it owns real estate. It owns commercial real estate, institutional, high quality real estate,
Could be anything, right? It could be apartment buildings, it could be retail centers, hotel, all kinds of different
medical
properties
facilities.
go
Yep.
into the trust. And sometimes some
Distribution.
of the trusts will own multiple kinds of assets in it as well, right?
Absolutely. So, two recent DSTs that I've worked on, just to give you an idea. One was a distribution warehouse, 100% leased to Amazon.
Hmm.
Clients love that, right? Because Amazon's going to pay the rent.
Right.
Another one that I'm working on now that's really popular, they run three senior care facilities in Minneapolis, Minnesota. A lot of demand for senior care facilities, right? So people look at that and say, that's a good investment. But that's the idea. They want to go out and buy high quality real estate. But that real estate, that generates cash flow. And so your client, if they invest in the Delaware Statutory Trust, they're going to get income every month or every quarter off of that investment. So um, they
And
get to
they're
keep,
going to get the pro rata tax benefits too, right? If they own
correct.
1% of a share of a DST, then they're also going to get 1% of all the other tax deductions that you.
Correct. They will get a tax form at the end, and all of that will show up on the tax form. So they get all of those benefits that you just mentioned. They continue to get income off of the money, so they don't have to give up that mailbox money. They keep getting that regular paycheck. And if they hold the DST until they pass, it qualifies for step up basis. So when you pass, you give the shares to your heirs. Nobody pays any tax. The elderly person, their capital gain is taxed at zero, and the heirs, they're taxed at zero. So with the Delaware Statutory Trust, you can legally get your tax rate down to zero. How can you do better than that?
Well, another, I love it. Another, what we've had other investor clients use DSTs is they might sell property one, buy property two, but even when they buy property two, they still have some leftover money.
Yes.
That's a great home because DST shares might be, I mean, what's the lowest share you've seen? 25, 50,000, 100,000? What would you say?
Uh, Probably 50,000, 70,000.
50,000, 70, right? So if I had $2 million I had to exchange, I found one property and I was left with $300,000, but I didn't want to pay tax on that. A DST is a great spot to park that and avoid having to pay the tax.
Absolutely. Because when you park it in the DST, you just did a 1031 exchange for that money.
Right.
And so since you brought that up, one other situation where the Delaware Statutory Trust is very helpful is if you're doing a 1031 exchange and you can't find a replacement property.
Mhm.
You have 45 days to list up to three replacement properties. If you can't find a property, you're going to have to pay capital gains tax. So in that situation, if you can't find a replacement property, you can at least, put the money into a Delaware statutory trust, park it there for a while and not have to pay the tax and find a way to buy a building later.
Love it. All right. Well, I know you got one more trick up your sleeve here, which is the charitable remainder trust.
Right.
Tell us a little bit about how that works.
Got it. So out of the three strategies, the charitable remainder trust is far and away the least popular. And the reason it's the least popular is, as the name might indicate, when you pass away, all the money in the charitable remainder trust goes to charity. So that's why people don't like it usually. All right, but there are some benefits, so we can talk about the some of the benefits. So if you'll go back to the first strategy that we talked about, the deferred sales trust. One of the benefits of that strategy is that we sold a $3 million property, just to refresh your memory. The client, if they wouldn't have done this strategy, they would have netted $2 million after tax. With the deferred sales trust, we can invest $3 million for them and they can get more income. If you do a charitable remainder trust, you get a similar benefit. There's a big pool of money and you get income off of that money. So in this example, it would be off of $3 million, not $2 million. So you're going to get more income off of that compared to if you sold the property and paid taxes. So you get income from that. So you sell the property, you give the property to the trust. The trust will sell it. They will have David Co. sell the property because we need an expert to sell that property. And then we got proceeds of $3 million. Because it's a charitable remainder trust, you don't have to pay tax. The charitable remainder trust is a charity, so they don't pay any tax. And so they get to keep all $3 million, and we're going to invest the $3 million. And because your client donated the property to the trust, they're going to get that income. So they'll get the 6% income off of the $3 million. They'll pay, ordinary income tax on that 6%, kind of like bank interest. And they keep getting that money until they and their spouse pass away. So if it's a married couple and they do this, they can get income off of that charitable remainder trust until both people pass away. When both people pass away, the money that's remaining inside the trust, that will go to charity.
Do you have to identify the charity when you put it in up front?
Um, yeah, well, I don't think you necessarily have to identify it. A lot of people do. And if you want to change, like 5 years in, you say, "Hey, I want to do something else," you can make a change. So you're not stuck with it.
And I assume you could also have multiple beneficiaries as long as they're all, legal nonprofit.
Legal nonprofits, there you go. So the reason people would do this is they have charitable intent. They want to give money to a charity. If they're not charitably inclined, they're going to be interested in the Deferred Sales Trust or the Delaware Statutory Trust. If they have some charitable intent, they may be interested in this. And again, so they're giving money away. They're getting income off of a bigger pool of money, $3 million, not $2 million. And then there's one other big benefit that they'll get that I want to make sure I mention. So your client, what they're going to do is they're going to take that property and donate part or all of it to the charitable remainder trust. You don't have to donate the entire property. You can donate 10%, 20%, whatever. But whatever you donate of that property into the charitable remainder trust, you're making a donation to a nonprofit. When you donate to a nonprofit, you get a tax deduction on your tax return. So
So not only
that's
do
the
I not
other.
pay capital gains, I can use it as a way to offset other
There
taxes.
you go. Right. Because
That's
you'll
awesome.
get on your Schedule A, you will take a deduction because you made a big contribution to a charity. So that's the second big benefit that you get is you'll get that big tax deduction. If you don't use it in year one, you can carry it forward to other years.
Love it. Isaac, man, this has been great. I learned a lot. Hopefully, people watching learned a lot. If they want to find out more information, how do they find you?
Uh, my email is my name. You can see down. It's isaac.kim@lpl.com. L is in Larry, P is in Paul, L is in Larry. Isaac.kim@lpl.com. Or if you want to check out my website, it's Isaac Kim, my name, Isaac Kim WM for wealth management, isaackimwm.com. And you can go in there and you can see more of what I do.
Awesome. We're going to take that, put it in the comments as well down below so people can do it. Isaac, thank you so much for your time. This has been really educational. And anyone watching this, if you also want to talk more about it, please let me know and we can have an initial conversation and then I can get you connected to Isaac as well. So
Sounds good. David, thank you for the opportunity. Really enjoyed it.
You got it, Isaac. All right, everyone. Take care.